Okay, on this last presentation, I've tried to brighten it up with some festive colors here. This is a very short section. Most Christmas tree producers are subject to the same federal income tax provisions as timber owners because the term timber includes evergreen trees that are more than 6 years old at the time severed from their roots and sold for ornamental purposes. So this definition includes Christmas trees. Christmas trees, therefore, are timber. And the rules that apply to timber will apply to Christmas trees. However, the reforestation tax credit, the reforestation deduction, and the 7-year amortization does not apply to Christmas trees. Christmas tree growing generally constitutes trade or business. Everybody that I know that grows Christmas trees complain about how much work it is, so they're going to meet those hourly requirements probably, if nothing else. As such, capital gains treatment depends on qualifying under Section 631A if you cut the trees yourself, or Section 631B if you sell the trees on the stump. The rules are the same as for any timber grower. It is possible, although unlikely, that a person who sells standing Christmas trees on an occasional basis could be considered an investor. In that case, the rules for investors will apply. The rules for deducting timber-related operating expenses and carrying charges apply to Christmas trees if the trees are more than 6 years old when cut or sold. We're going to get into a little sneaky rule here on this 6-year-old stuff. The trees have to be 6 years old. Since Christmas tree growing is almost always a business, the favorable rules for deducting business costs are applicable. However, the passive loss rules apply. And now they've gone on to say they changed this rule a couple of years ago. Shearing and basal pruning costs are deductible business expenses. They used to require you to capitalize those expenses. Income realized from the sale of Christmas trees is subject to the same rules as for timber. However, there are some unique aspects that need to be considered. John's already talked to you about Section 1221. In most situations, Christmas tree growers will be considered in a business. Therefore, you should not rely on Section 1221 if you wish to report the proceeds as capital gains. But again, this is not going to be a big problem starting with this year because of the new rule on lump sum sales. Section 631B, you should use this section to report the proceeds as capital gains for standing trees. Usually the unit of measurement is going to be the individual tree, or it's going to be expressed in terms of linear feet. So you've got a different unit here than you do with timber. You could be required to use Section 631A to report the sale of proceeds as capital gains of cut Christmas trees for the wholesale market. You should use the provisions of Section 631A. It is immaterial whether you cut the trees yourself or hire someone to cut them for you. So if you're selling cut Christmas trees, 631A. If you're selling standing Christmas trees, 631B. We're going to have an example here in a minute. So under Section 631A, you need to determine the fair market value of Christmas trees on January 1, or the first day of your tax year of the sale year. And you're going to see here in a minute why some Christmas tree growers have their fiscal year begin on November 1, because that's the day they typically cut their trees. It may be difficult to determine the fair market value on the first day of the year, but you should use your best estimate of what the trees could be sold for on the first day of the tax year based on their condition on that date. Now, every now and then somebody will say, yeah, but Christmas trees aren't worth anything January 1. Well, if they're still growing in the ground and you know you can sell them in 11 months, they're worth something. Yeah, if they're cut on January 1, they're not worth any, or January 1, they're not worth much. So here's one of the tortured interpretations here. Typically, choose and cut Christmas tree sales do not qualify for capital gains treatment under Section 631B. This is where you go out with your family to have this wonderful holiday experience, and you go down and to the farmer's woodlot, and he's got his little hut and the apple cider heating up on the side, and you take a saw and you walk down with your family and pick a tree and cut it down and bring it back up. He measures it and then charges you so much per foot. Here's the way the IRS looks at that. Under these circumstances, the buyer does not have a contract right to cut the trees. He may choose not to cut the tree at all at his option. When the customer cuts the tree, however, he has an obligation to purchase it Therefore, the grower is considered to be selling cut trees and should elect Section 631A to receive capital gains treatment, which is a long, tortured process to go through when you do your taxes. I have yet to meet a Christmas tree grower that runs a choose and cut lot admit how he reports it on his taxes. So let us assume you are a calendar year taxpayer and you establish 5 Christmas tree plantations comprising 10 acres each in 5 successive years, each containing 12,000 trees of a fast-growing pine species. 2-year-old nursery stock was used, so the trees in the first plantation qualify as timber under Section 631, because they're more than 6 years old. Being a 2-year-old nursery stock, plant it 5 years later, those trees are 7 years old. Kind of sneaky in a way, really. All right, but they do qualify as timber. You spent $1,210 to establish the first plantation. Later you incurred $1,060 in capital costs for certain carrying charges you choose to capitalize and the cost of replanting lost trees. So now the adjusted basis just before the first cutting in November amounts to $2,270. Now you have 11,000 well-formed trees, of which 6,000 are of sizes to be cut this year and 5,000 are to be left for further growth. So you come up with a depletion unit of 21 cents per tree by dividing that $2,270 adjusted basis by the 11,000 trees. You cut the 6,000 trees yourself and deliver them to a wholesaler who pays you $4.30 per tree. So your total cost for cutting and delivery is $1,800. Since you are selling cut trees, you correctly elect to treat the cutting and sale as a Section 631A transaction. Selling cut trees, 631A transaction. Well, now you've got to determine the value of those Christmas trees on January 1. And here's a method that you can use to do that. The value on January 1 can be estimated by discounting the value when cut for 10 months as follows. Let us assume that the trees are worth $3.60 each on November 1 when cut. Let's assume the applicable local interest rate is 6%. We pull this out of the air, but anyway, this is the rate we used. And so those Christmas trees that you sell November 1 at $3.60 are worth $3.42 on January 1. You just discount it back 10 months at 6%. So the gain from the cutting is 6,000 trees times $3.42 per tree. It's equal to $20,520, less your depletion unit of 21 cents per tree, and that is equal to $1,260. You subtract that from this, and you get the gain on timber. It's taxed as a capital gain of $19,260. Then you go to the gain on the sale of the trees. 6,000 trees that you sold on November 1 at $4.30 each, and that equals $25,800, less the value on January 1, etc., etc. You deduct the value on January 1 and the cost of cutting and delivery, and so you have this other portion, and John's already gone over this with you. This is the portion that you've got to pay ordinary tax on, ordinary income tax. So you've got 2 taxes to pay in this situation with 631A. You've got the capital gain associated with the standing timber, and the fact that you're not selling standing timber, you've actually cut those trees and hauled them to the seller so they're worth more. You've added value to those standing trees after you cut them, and you pay ordinary income tax on this gain right here. Life's a little complicated like that. So let's look at another example. Let's assume you decide to sell standing trees to a jobber rather than harvesting them yourself. So how do you determine your taxable gain? Well, life gets a lot easier here. 6,000 trees at $3.60 per tree, less a basis of 21 cents per tree, less your sales expenses, and that's equal to $20,220. And if the cutting contract qualifies as a disposal with an economic interest retained under the provisions of Section 631B, the $20,220 will be reported as a capital gain. Otherwise, this amount is going to be reported as ordinary income. So that's Christmas trees. Any question on Christmas trees?